A few days ago, when I saw the BSE Sensex trending lower, going below the 78,000 mark, moving towards 77,000, or maybe it touched 77,000, I'm not even sure. But when it was trending lower, I did start to feel like a bit nervous, but I kind of, talked myself out of it, thinking that, okay, you know what, this is going to be for a few months, we're in for a correction, and I prepared myself to see the red in my portfolio. But that didn't happen, and the Sensex has now moved back up above 80,000, and I have to admit I am feeling a little bit more relaxed and good, in fact, looking at my portfolio value. The thing about long-term investing, or even trading, but we're talking about long-term investing here, so let's stick to that. The thing about long-term investing is that it needs to be devoid of emotion. It needs to be objective, and it needs to rely on the goals that you're investing for and the assets that you have chosen for those goals rather than on emotions, right? However, we are human beings and emotions do come up. I feel good, I feel bad. I feel good when I see my portfolio value swell up. I feel bad when I see it go down. The trick is not to kind of try and repress those emotions. The trick is to not react to those emotions or because of those emotions. Rather think about things a bit more logically. The only reason why you should be getting worried as a long-term investor is if the quality of your investments, the quality of the stocks, bonds, or whatever it is, whichever asset that you hold in your portfolio is suspect and it's not good quality, then you need to start worrying, because when the markets correct, good quality also corrects as well as bad quality assets correct, but the bad quality doesn't move back up when the trend reverses, okay? But your good quality assets are going to climb back up as far as price is concerned when the trend reverses. So that's one reason to worry if you don't have good quality stocks or bonds in your portfolio. The second reason to worry is that if you're very close to your goal, you're 6 months away, and this volatility is kind of not really settling you down, then you know what? Take out the money that you need for your goal. It will give you peace of mind. It will help you relax. Leave the rest in. You see, we do know that equity markets go through ups and downs. The volatility is short or medium term in nature. Over the years, we have seen that with all the kind of information around, all the events that are happening, they do affect daily prices, right? But as long as the fundamentals are good, as long as you feel like the Indian economy is going to be doing well over a long period, then you have to remain invested, okay? And you have to kind of disregard the immediate news and the immediate events. And there is lots happening. Our GDP has come in lower than expected. There is inflation. There is the US elections, the state elections in India. There is a lot of things happening, and geopolitics continues. So there is a lot of noise. Valuations are high. So I can totally understand the nervousness. The thing is whether you react to that nervousness or not. And as I mentioned, the first thing to check is the quality of your portfolio. This is a good time to get rid of the bad quality and hang on to the good quality. The second thing is to check your goals, your goal timelines, and stick to your assets which you know will help you achieve your goals in that timeline. Remember, the corrections, the events that cause these corrections, the noise, the chaos, it's all short term. Your investments, however, are long term. So don't let your short term events, news, emotions even impact your long term goals in any sustainable manner. You have to check those emotions and kind of convince yourself not to react to emotions that you feel around your portfolio. Rather, think logically. We have not seen the Indian equity markets going to zero ever. So, so just stay put, check quality, check your goals, and that's all you need to do.